If your chart looks something like this, you need to change your strategy. No matter if the last couple of trades ended up in profit, or if you have been profitable for some time now, most likely you're purely working with luck here. So let's answer the question. Are indicators helping you trade better, or is your chart filled with unnecessary noise that ends up contradicting each other and you just have to pick which one is correct? Traders over-rely on indicators because they often promise a shortcut to certainty in an inherently uncertain market. An indicator is nothing more than a calculation or a piece of data displayed on your chart. Yet the internet is filled with videos such as "use my indicator and you are guaranteed to be profitable," which isn't anything else other than people trying to make a bit of money on new naive traders thinking that there is some sort of shortcut to this game. The key is to simplify your approach and cut out all that noise. Instead of stacking a dozen indicators, pick one or two that actually complement your trading style and accurately confirm what the price is telling you. For most, that often means focusing on pure price action, clean charts that let the market speak for itself. I mean, let's look at this. What can you read from this chart? Can you even tell what's going on? All of these lines and drawings only get in the way of being able to carefully analyze what the price action is doing. Your chart is loaded with conflicting signals. For example, one indicator suggesting you enter long, while another hints it's time to exit. You end up second guessing yourself. This mixed messaging creates hesitation, leading you to either sit on the sidelines or make rash, uncalculated moves. In the end, you either miss the sweet spot or jump in too early, both of which set the stage for bad trades. This is what my chart looks like. I trade supply and demand, and the only indicators I have are, as you can see, a volume indicator to help me identify the big moves. I have a 200 EMA to help me identify the bias, and a session indicator set to New York to help me analyze what is going on in the market, because most liquidity zones that were set outside of the New York session tend to get wiped out during the New York session. So which ones should you use? Well, it isn't as easy as one indicator being more profitable than the other. They can be a great tool as long as you use them correctly along with a strategy that works for you. Because what matters most is price. Price action is everything, because it's what the price is doing right now. It's the direct evidence of buyer and seller decisions. It shows you the current market movement without any delay. Indicators, on the other hand, are based on past price data. They work best when they confirm what you already see in price action, rather than leading the decision-making process. When you rely on price action first, you're basing your decisions on what is actually happening in the market at that moment. Indicators should only be used to double-check that information. Despite all of this, not all indicators are created equal. Some are just noise, while others can give you real clues about what the market is doing. So let's start off simple, the exponential moving averages. Like the name suggests, moving averages are a calculation of the average price of an asset over a set period. They are useful to determine exactly where the market is heading. Is it trending up? Is it trending down? Or is it consolidating? Moving averages are pretty universal and can be used in strategies based on trend following, breakout strategies, scalping, and even supply and demand. They don't have to necessarily be used only as an indication of direction, but can be used as signals and confirmations for entry or exit. Like in this example based on supply and demand, where a trade will be opened only when the price reaches a supply and demand level, as well as tapping the 200 EMA. Next, let's cover Bollinger Bands. Bollinger Bands are a tool that helps you see the range where the most of the price action happens. They consist of a middle line, usually a simple moving average, and two outer bands that move further apart as the market becomes more volatile. When the bands are wide, it means the market is making big moves. When they are narrow, the market is in a calm, low volatility phase. These once again can be used in many different ways. When price hits the upper or lower band, it can be an indication of the asset being oversold or overbought. Some traders use it as a cue for a potential reversal. It can be used as a signal to open a position if used in confluence with other signals. It can act as a dynamic support and resistance level, which is both useful for reversals and breakout trades, for example when the price bounces off of them. It can also be very useful on shorter time frames, and scalpers can use Bollinger Bands as help to spot quick opportunities. Like a sudden punch through the band might indicate a short-term move a scalper might want to chase. In short, Bollinger Bands are a versatile tool to help you gauge the market volatility. The next indicator on the list is the relative engine to help you identify when an asset might be due for a pullback or a bounce. Typically, readings over 70 suggest that the asset is overbought, meaning it may have climbed too far too fast and could soon reverse downward. Readings below 30, however, indicate oversold conditions, where the asset might be undervalued and ready to bounce back. This is to be taken with a pinch of salt because, just like any other indicator, I have seen scenarios where the RSI was over 70, yet the trend continued higher without dropping below it. RSI can be used by swing traders, where traders will look for divergences between the price and the RSI. For example, if the prices are making new lows but the RSI is not, or vice versa, this can signal that the current trend is losing its strength and might reverse, giving you a potential entry point. They can also be used in breakout trading. When a breakout occurs, the RSI can help confirm the move. If the price breaks a key level and the RSI shows an increase in momentum, it adds confidence that the breakout is real and it might have staying power. Lastly, it can be used by scalpers. On very short timeframes, a quick change in the RSI can hint a burst of momentum. Scalpers can use these signals to capture small, fast moves in the market. Since the RSI responds quickly, it can provide early warning signs to jump in or out of trades. In all of these scenarios, RSI was used as a confirmation tool rather than the sole basis for a trade. By pairing RSI with clear price action, you can make more confident decisions. If used alone, however, it is very dangerous. The next indicator I will cover is the volume weighted average price, also known as VWAP. It's a really useful indicator if used correctly, as it's used by institutional traders, and it's a good idea to be trading with the big players rather than against them. VWAP is an indicator that calculates the average price of an asset throughout the trading day, based on both price and volume. It gives you a single line on your chart that represents the fair price for the day, factoring in the amount of trading that occurs at different price levels. Institutional traders and large players rely on VWAP as a benchmark to measure the performance of their trade executions. They often aim to buy below or sell above the VWAP to ensure they're getting a better deal than the overall market average. For everyday traders, VWAP is just as valuable. It acts as a dynamic support resistance level that helps gauge the day's overall market direction. You can use VWAP in many ways, for example, to compare where the current price stands relative to the day's average, which can give you signals. If you're trading above VWAP, it might signal trend strength, but there's many ways to use it. Who would find VWAP useful? Breakout traders could use it as confirmation. When the price breaks above or below VWAP with high volume, it could indicate a strong directional move. Scalpers. On shorter timeframes, VWAP helps scalpers quickly assess whether they're entering a trade at a realistic price level relative to the day's trading activity. Supply and demand. VWAP can serve as a marker for areas where institutional trading is likely to take place. If the price pulls back to VWAP, it might reflect an area of accumulating orders, acting as a magnet where supply meets demand. In summary, VWAP is a versatile tool used by both big institutions and everyday traders. It provides a real-time average price that helps you understand market bias, determine entry and exit points, and even gauge supply and demand dynamics throughout the trading day. You see, all of the mentioned indicators are versatile and can be used interchangeably between strategies. This does not mean that you should turn on all of them if you're a scalper, because that's once again too much noise to focus on price action. Instead, you should focus on finding an indicator that suits you best and adapting it to your strategy. For example, some people might find it easier to read VWAP than others, therefore that's the one they should use, but that's for you to decide. These are also not the only indicators out there, and there are ones just as good, so do your research if these are not for you. This will be it for this video. I hope you learned a thing or two. Don't forget to leave a like or a sub, and remember, 90% of traders lose 90% of capital in 90 days.